Going into yesterday's print, you were of the view that any uptick in inflation would be largely temporary. Do you still hold that view?
Yes, good morning, and thanks for having me. Yes, we still do. Obviously, we have maybe a bit less of confidence, but we do believe this is going to be temporary. Look at the categories, price categories that have driven the surge in consumer prices. It's most of the increases can be basically be traced back to 4 or 5 price categories, very much related to either what's going on in the car sector. So a lot of a shortage in the supply of new cars, which is driving up the prices of used cars, and then the reopening effect on the economy. So for how long this might last, I don't know. This is really the key question, right? I suspect there might still be some months ahead of a pretty robust price growth. But as long as this is related to, let's say, this reopening impact and this issues going on in the car sector, I do believe that the Fed will try to keep looking through it. But the Fed has to be open-minded. Right? Yesterday, we learned from Clarida that obviously they were surprised as well, right? And they will remain open-minded because if there is a worrying, de-anchoring of inflation expectation, they will have to react. It's not our baseline. The risk has increased, but we still think it's transitory. And to understand whether this is really going to get concerning for the Fed, you really have to look at the broadness of the categories of price increase that you see. Now it's 4 or 5 price categories. If that's going to be increasing going forward, that's going to be a concern for the Fed.
Helpful lens through which to look at incoming data. Why do you think we had such a big market reaction yesterday, given the rise in inflation was so well flagged? Was it simply because inflation took off to a higher degree than analysts had been expecting?
Yeah, absolutely. We were not expecting 0.9% month on month on the core. I think that's about twice as strong as we would have predicted, right? So this was a sizable surprise, and it's clear that the market had to react. But again, I think what is really important to understand is how broad and how widespread are these price increases going forward. And ultimately, if this becomes broader based, then the Fed will have to react, and markets will not like it because a lot of the pricing that you have seen in markets, especially for risky assets, is based on the assumption that the Fed would remain extremely accommodative, at least throughout this year, and tapering will only start next year. If they have to bring that forward for whatever reason, because inflation is just running too high for their comfort, then markets are not gonna like it.